Okay, hello everybody. Welcome to our webinar today on insuring commodity crops using whole farm revenue protection. And this webinar is for crop insurance agents and other finance professionals. I'm going to start things off by doing a few introductions. My name is Anna Johnson. I'm a policy associate with the Center for Rural Affairs. We're a nonprofit organization and we advocate for healthy rural communities. We're based in Nebraska, but we work nationally. And we believe that healthy small and mid-sized farms are a key component of healthy rural communities, and so access to good risk management strategies is a part of farm viability. So we are holding a series of webinars on the crop insurance program Whole Farm Revenue Protection, which is a fairly new program, and it is designed for diversified operations. Today's webinar is aimed at commodity operations, as you know. And we have two upcoming webinars that focus on livestock operations, and we had two previous webinars focusing on this program's application for specialty crop operations, and we'll be posting recordings of the webinars on our website. So today we are going to hear from two experts in this program, Whole Farm Revenue Protection. Our first presenter is Scott Marlow, who is the Executive Director of Rural Advancement Foundation International, which is a North Carolina-based nonprofit organization. And Clif Parker is our second presenter, and he previously served in USDA's Risk Management Agency, which is the arm of USDA that administers crop insurance, as you know, and he was an Assistant Deputy Administrator for Insurance Services there. Cliff now works as an independent risk management consultant. So here's how things are going to work today. We have an hour, and Scott and Cliff are going to each present, and then we'll have about 20 minutes at the end for questions. You should have a webinar program window on your screen that has a questions function in it. So feel free at any time during the presentation to put your questions into that box, and we'll be monitoring them on our end, and we'll bring them up at the end during the question period. And so yeah, with that, I'm going to hand it over to Scott. So I'm sending the screen over to you. Okay.
Thanks very much, Anna. I appreciate it a lot. Again, my name is Scott Marlow. I work with the Rural Advancement Foundation International. We're an organization that works all the way from on-the-ground direct work with individual farmers, both in financial crisis, but also the development of new farm enterprises through federal and international policy work. So we work all the way from the very local to international. Our work and my work on this policy came out of a conversation about 12 years ago with a banker and a farmer that I knew who was producing grass-fed beef. And the farmer had an MOU to sell all of his beef to a local supply company and was trying to get a loan to increase his herd, and the banker wouldn't touch it. And we were going around and around on why the banker wouldn't do it and all that, and halfway through the conversation, 3/4 of the way through the conversation, I said, wait a minute, if he had crop insurance on that income, would you lend him money on it? And the banker said, sure, in a heartbeat. And all of those other issues went away, and that started our work on this, and I think, and conversations like that are what really got us going on this crop insurance piece. And so we see it as very important, and whole farm revenue being a very important step in this process. So for folks who sell crop insurance and are familiar with it, on this webinar we're talking to folks who have worked in commodities. As you probably already know, crop insurance is really the primary way that government covers production losses in any kind of a disaster. We used to do ad hoc disaster programs. I worked on a bunch of them back in the day, but ever since they passed a permanent disaster title, they're just not doing that anymore. So what you have in crop insurance, with a few exceptions, is kind of what you got. Crop insurance, as I said, drives lending. It really changes how an operating loan is collateralized, and we can see that we're facing some really changing weather patterns and more extreme weather. Crop insurance has been an option for a whole series of commodities. But we also see that for that farms who may sell into a higher value market or may have something on the farm, most folks that I know on the farm have something besides just their commodities that they're making money off of. It could be just about anything. Grass-fed beef going into a direct market, a pumpkin patch for the kids in the fall, whatever it is, and that income generally goes uncovered. And so this policy is really designed to be able to cover, to fill in all of those gaps. So there may be uninsured income either from their regular commodity crops going into specialty markets. I used to work with some soybean growers who were selling soybeans into a tofu market in Japan that was a higher value of soybeans. That added value could be covered here. Or there may be an uninsured other on-farm enterprise. So this is also important because it provides a new market for crop insurance agents. It's serving the very growing market for specialty crops and higher value products. We're seeing more and more demand for, not just beef, but grass-fed, rare breed beef or other types of specialty products. It's an opportunity at this point, because this is such a new policy, it's an opportunity for agents to differentiate in markets by getting ahead of the curve on understanding how this policy is administered. And I would add that for bankers, this is a really important way to extend your ability to lend to farm enterprises that you may not have been familiar with or may not have been able to serve effectively. This is working with them to get access to this policy can really extend your pool of business. So what's special revenue? Well, it incentivizes diversification. The more different crops you grow, and the better the deal is, the better the coverage is. It recognizes that as you diversify the crops, the risk to your whole farm revenue goes down. It recognizes the proven price that a farmer gets. So, like I said, if I have some kind of a specialty market that I've been able to carve out, I can get insurance at that price rather than a commodities price. And it allows insurance on things that previously were uninsured. It's just about everything. Just about anything that's farm revenue that goes onto your Schedule F can get covered here. So what is being insured is the revenue from the whole farm operation. This is gross revenue from the whole farm operation, and that's determined by the 5-year average of the Schedule F, filed in the person's or the farm's taxes. For beginning farmers, if you've been farming fewer than 6 years, that requirement can be cut down to 3, but generally it's 5 years. Also note that because in general taxes are filed after the deadline on this policy, there's often a lag year in terms of the 5-year average. So, an application in 2017 would probably not include 2016 Schedule F, so it would be 15, 14, 13, 12, 11. The loss is then determined by the Schedule F from the insured year. Once again, so payment has to wait until you file that, which is usually in the next year. And the rate of coverage is up to 85% of that 5-year average. Whole farm is great for diversified operations who may have income from crops that are valued other than the wholesale price. When it's available, because of the way risk analysis works, regular multi-peril crop insurance is probably going to be more cost-effective for some of those pieces, although the subsidy level on this on the whole farm revenue makes it an incredibly good deal. But multi-peril crop insurance can be nested within the whole farm revenue policy, and in that way, any kind of payments from a multi-peril crop insurance policy get placed against the whole farm revenue income. So they can get multi-peril for like corn and soybeans, but then use whole farm revenue to cover the rest of their gross farm income. So how this works, let's say farmer Anna has a history of producing $100,000 each gross from corn and soy, $50,000 from direct market grass-fed beef, and $50,000 from a specialty wheat that they're selling to a local miller for a special whole wheat bread. So her average revenue is $300,000. With that diversification, because it's 4 different crops, the coverage can be at the 85% level, and 85% of that $300,000 is $255,000. So basically, that's our level of coverage. So if she takes out crop insurance on the corn and soy, any payments from those policies just become part of that income that counts against that $255,000 level. So if she loses half the income on the beef and half of the wheat, that remaining income is $250,000. Y'all understand how this works. The indemnities with that 255, the coverage, it's the indemnity is 5,000. I think I messed that up a little bit. But in that same scenario of loss of half of the beef and the wheat, if she makes an extra $20,000 each on the corn and the beans, then the income is above the loss threshold and she doesn't receive a payment. So if she's getting $120,000 each from the corn and the soy, then that bumps her back above the and that's how the whole farm part of it works. So in our experience, there's some important considerations to take into account, especially the first time. It can be a little complicated. It's not as complicated as some things, but the first time somebody goes through the process, it can be complicated, so it's not good to wait until the last minute. It does cover minimal processing needed to bring something to market, like putting it in a box or drying, but it doesn't cover anything that really adds value. So if grain was being milled for wheat or something like that, it wouldn't cover that. One of the important issues here is understanding the growth factor, and Cliff will go more specifically into that. If you have a 5-year average and your farm is growing, there's a factor that you can take into account that can increase that level of coverage beyond the 5-year average. Really understanding how much that increase is an important part of the puzzle, because if your farm grows faster than that factor grows, then that effectively can reduce the level of coverage. So I'm really glad that we're doing this webinar about whole farm revenue and commodity producers. This is really a market that is so far untapped. For the most part, whole farm revenue has been used by folks who are doing multiple specialty crops, heavily fruit and vegetable producers, some folks who have like higher value direct market beef or things like that. But this area of using it for commodity producers is really something that we're just starting to understand and really seeing how this tool can be an important part of a farmer's risk management toolbox, and can really help cover some of those places on the farm where they have income that has never been able to be covered in the past. So I'm really glad that we're talking about it in these terms, and I'm grateful for the opportunity to talk to folks about how, what this opportunity looks like. And with that, I appreciate it very much. And Anna, I'll throw it back over to you and Cliff, and then I'm here for questions in a little while.
Great, thank you so much, Scott. This is really helpful. Okay, Cliff, are you ready?
I think I am. Let me bring my PowerPoint up. Is it up? Show my screen. Let's see. First of all, I'd like to thank everybody for taking the time, agents, finance managers, bankers, whoever is on this call. I work with an agent in North Carolina to do as a consultant for this whole farm, and he sold quite a few of these policies. Some of it being to commodity producers, some to vegetable producers, a mixed blend. But one of the things I have done as a consultant is work with bankers. Matter of fact, I spoke with 2 this week. 2 big, they really weren't bankers, they were ag lending institutions, and they are really excited about the whole farm because it opens a whole new revenue for them as loan underwriters, areas where even with commodity crops, they had some apprehensions, even with the revenue programs we have, because the revenue programs that we have with crop insurance, yes, they're revenue programs, but they don't always equate out to exactly how much money the farmer's going to get at the end of the day. This product does. And that's one of the things that as bankers, they really want to know. They don't want to know you're going to get 100 bushels of corn. They don't care. They want to know, are you going to bring in $500? Now, I'll give you a little bit about my background. I grew up on a small diversified farm in North Carolina, and very diversified. We grew everything that we ate. That's how diversified we were. And we sold a good majority. I lived close to the beach, so we had a lot of truck traffic, and a lot of traffic, so we did a lot of truck crops on top of our commodity crops. So I think Scott mentioned this earlier, is that a lot of farmers do have commodities, but a lot of them like to have a little money on the side, and they'll go out and sell pumpkins, watermelons. They'll have a few of these other crops, sweet corn, things like that, to supplement their income. I'm a graduate of NC State, and then worked for I don't know how many years with RMA, too many to count, and retired with USDA in 2007. And since that time, for like the last 10 years, I've been doing 9 years, been doing agricultural risk management consulting with everybody, agents, bankers, farmers, private companies, you name it, all over the board. What's covered under whole farm? Really easy. Pretty much everything on the farm. Animals, animal products. You can even cover some of your resale things that if the farmer buys a little bit of products to sell, he can cover that. Timber, forest products, animals for sport, all that's is not included because they don't consider that mainstream agriculture. Replant cost. This is a really good sales tool for agents out there. Is replant cost is included, and what it is, it's 20% of whatever the insured revenue is for that crop. So if the insured revenue on that crop, I mean, if you guarantee in, if the commodity crop, say corn, is $100,000, then if they have a replant kick in, we can pay up to $20,000. So it's 20% of whatever the revenue of that crop is worth, based on the operations report that's done for the crop. So that is a really good sales tool for replants, and it's really good for people that's financed them also, because if they have a major loss up front on a crop and they can't replant it or don't have the money to replant it, it's impossible for them to make money to repay a loan. So that's very important to the farmer, crop insurance agent, and the person that's financing the operation. Coverage levels goes really high, all the way to 85%. To qualify for 80 and 85%, you've got to have at least 3 commodities. If you have 1 or 2 commodities, in most cases, I'll get into exclusion, but in most cases, even with 1 or 2 commodities, you can still buy this insurance. It's just not quite as good a deal because it's not subsidized as much, and you can't buy as high a level. There is no catastrophic level of coverage. We're talking today, I think, with agents and finance people, so they pretty much understand what the catastrophic level is, and that's not available for a whole farm. Historic revenues adjust to reflect farm expansion. This is a really really good item that we push for to get changed. The growth can go all the way up to 35%. First, you got the indexing, and the indexing, if a person's 5-year average is $1 million, and the last 2 years, the 15 or 14, for 17, it'd be 15-year and 14-year, is more than that 5-year average, is greater, either one of those years is greater, they qualify for indexing, and the indexing can increase their overall revenue history average by 10%. Now, the expanding operations, let's say you got 100 acres of corn, and this year you're going to 125. That's a 25% growth. You can show that. You can show you're renting the land or whatever. You can prove that to the agent and underwriter. Then you can increase to 25%. You can do that all the way up to 35%. Cost for market readiness. This, for commodity crops, this is not quite as important because you don't do a lot to corn, soybeans, and all that. What this is for is the minimum that's required to bring a commodity to market is what's covered. If you've got to put it in a box, take it to market, that's covered. But no added value. You can't do added value things like making jelly, making butter, or putting a bow around a pumpkin, things like that. That's not covered. This product is designed to care for production of the crop. That's what it's for. Other crop insurance policies covering individual commodities may be purchased. Really important for agents. If you've got a farmer he's already buying corn, wheat, soybean coverage, but he's also growing sweet potatoes, he's also growing sweet corn, pumpkins, those commodities historically don't have federal crop insurance. The only thing that was available on that was NAP. And a lot of farmers, there's a lot of issues there. They may not have taken NAP, they may have, may not have. But they can buy buyout coverage on those 3 commodities, and that will actually come off. The liability for those commodities will come off the liability of the whole farm before he pays premium. Now, that won't lower the liability of the whole farm, but it will actually come off the liability for premium purposes up to 50% of the liability of the whole farm. So as you can see, if you got somebody that's got corn, sweet potatoes, and sweet corn, and their corn, they go ahead and buy MPCI, and their overall guarantee is $500,000, and the corn liability is $200,000. They only pay premium on the whole farm at $300,000. That's a very good deal for the farmers also. Now you got to remember, any indemnities off that corn, if they bought that corn coverage, counts as revenue against their revenue to count also. Because what we're doing is guaranteeing with government payments, with crop insurance, with sales of your crop, you're going to bring in whatever that guarantee we guarantee you. It's real money. All farm revenues is insured under one policy. You may have some clients there that says, look, I've got 5 crops. I want them covered, but I just don't want the hassle of 5 separate policies. I just don't want, this is perfect for them. They got 5 crops. They can put them all under one policy. You guarantee them one set dollar amount. A lot of farmers want coverage by farm seal number. And then they have to buy the MPCI on your commodities, and you get that. But as we know, that gets expensive. With this, you can put them all under one policy. They got 5, 6 crops, all the way up to 7 crops. It lowers their premium rate, and then they can get that subsidy if they got more than 2 crops, 80%. That makes it really affordable, and that may open another opportunity. Some people have always said crop insurance is too expensive. This really brings it back down to where it makes it real affordable. Premium subsidy, we've already talked about that. It's up to 80%. Here's the chart. If you have any dealings in the past with crop insurance, you know that most crop insurance is subsidized. If you got 1 crop, it's subsidized at 55%. If you got 2 or more crops, it's subsidized at 80%. If you've got 3 or more crops, you can actually buy 80, 85% level, but as you can tell, the subsidy drops to 71% at 80 and 50% at 85. But bankers, it's one thing to keep in mind. You may have to, most people, the way I'm seeing it now, and if we go through our database RMA, they say most people buy at the 75% level, but there is customers that I know of out there that are having to buy to 80 and 85% level because to get a loan, because they can't get enough revenue protection to get the operating loan they need, so they do have to buy the 80 and 85% level. So it's great that it is offered. Real simple to tell you where this is offered at. It's not like a lot of our commodities. You had to look at actuarial documents to see if it's offered in X county, Y county. This is offered in every county in the United States, and it's the first product we got that's like that. Now, it's got a few exclusions. Anything this good's probably got a few exclusions on it. We got one of them. If you're over 17 million, you're excluded because 50% level is the lowest you can take, 8.5 million. The next thing that's excluded is anyone that has over $1 million in animal products. So if you got over $1 million of animal products, you're excluded from this policy, or you have over $1 million in greenhouse and nursery. Keep in mind, floriculture, cut flowers, is not considered in that $1 million because by RMA that's not greenhouse and nursery production. Okay, what kind of farms would you look at that this is suitable for? My opinion, it's suitable for every farm out there. I think every farmer that's farming in the United States needs to look at this policy. I did not say need to buy it. I said they need to look at it. Somebody needs to sit down with every farmer and show them this policy because it will work for a lot of producers. It will work in conjunction with the crop insurance we have. It will work sometimes better than some of the crop insurance programs, but they need to look at it and they need to put it into their risk management strategies. And they need to look at it as another risk management strategy. Okay, so diverse farms, it's definitely suited for them. One crop, it's okay, but if you got more than one crop, the subsidies and the diversification factors, it makes it really outstanding product. It's available to all farms and ranches that qualify. There are some qualifications, and I'll get in. There's a couple more exclusions. One of them, and it's later in the slides, but I'll go ahead and hit it since I'm on this topic of what's available. Get back here. If you're a potato farmer, if you have a potato farm and that's all they farm, they cannot qualify for this product because the law states we can't insure revenue potatoes solely. So if they got 2 crops, potatoes one of them, yes, they qualify. If they got only 1 crop and it's potatoes, they don't qualify. If they only have 1 crop that's insured under a revenue product, corn, wheat, soybeans, cotton, that we have a revenue product already available, and that's only one commodity grow, they do not qualify for whole farm. If they grow corn and soybeans, they do qualify, okay, or any two commodities. Whole farm insured revenue is the lower of. I'm going to tell you, as agents, there is a little work to this product, but it's not as bad as a lot of people thought it was when it first come out, because a lot of people panicked and said, "We know way we can do all this work." There's nothing easy about selling crop insurance, whether it's MPCI, whether it's whole farm, or none of it. There's paperwork, there is record keeping required and all that. But with this product, you need 5 years of Schedule F. You got to have that. You got to have 5 years of the Schedule F, and you have to look at that and see what's actually brought in. It's line 2 or 4A, depending on the years, 2A or 4A of Schedule F, top line, and it's the gross revenue for 5 years. And then you have to come up with what the farmer plans to plant that next year. I've already talked about this. Does diversification matter? Yes, it does, for several reasons. The more diversity you have on the farm, the more commodities, the lower the premium rate. You've got to have at least 2 crops to get the 80% subsidy, and up to 7 crops you keep getting lower and lower premium rate. Now the subsidy maxes out at 80%, so with 2 crops you get that max. And I've already talked about this slide here. It requires 3 commodities for the 80-85% level, and you got to have 2 or more commodities to get the 80% subsidy. Diversification measure already determines the amount of diversification discount to the premium rate. That goes all the way up to 7 crops. So after 7 crops, you get no more diversity factor. Other facts to understand about whole farm is if you produce a crop and it's in inventory, it's in a bin or somewhere, it has to be appraised at the end of the insurance year to see what the value is, because this product covers what is raised that year. Now, if you sold something but you haven't got your money yet, we do an accounts receivable report for that at the end of the year, the agent does, and what we have to do is determine what it's worth. It's sitting out there, a guy owes you $200, and that's $200 that goes on your this year's income because it was raised this year. So there's inventory that you have, there's accounts receivable that has already been sold, just haven't got your money. Prices to used to value commodities to be grown must meet the expected value guideline to policy. Now, with this policy, as an agent and a consultant to agents, the most difficult part is not coming up with a Schedule F. All farmers do taxes, so they've got the Schedule F. You can get that. You can get it from their accountant email most of the time. The problem coming up with prices, farmers' records are not always the best in the world. You can use their actual production history to come up with records, and you can use their price, and it's better to use their price, much less if they're an organic or they're selling something outside the mainstream. But if they just do not have records of their prices, got to have Schedule F. There's a lot of different means you can use. You can use some of the market news prices. You can use NAP prices that they have out. You can use RMA's price selection as prices. And you can use the T-yields. You can use the NAP crop tables. You can get those from FSA that tells what they say an acre is production is for the state, and also the price. So there's a lot of avenues. That is probably the most difficult part of being an agent on whole farm, is doing that, is being able to get those prices in production. And if you've been an agent historically with crop insurance and you do APH reports and crop acreage reports, you know about that. I don't have to explain any further to you. That's probably the most difficult part of selling crop insurance. Well, it ain't almost. It is the most difficult part. Okay, natural cause of loss are covered. This policy is the most inclusive for perils of any insurance policy I have seen across the board. And I'm talking about any of your PNCs, any of your health, life, anything, because it covers all natural causes of loss. It covers and a decline in market price. So it's market price and it's natural causes of loss. That's real good coverage, really good. When the revenue to account for the insurance year is lower than the insured revenue, a loss payment's made. This is the way it works. Guy's got an average of $1 million. You insure him 75%. He's got $750,000 coverage. The price drops on corn to $1 a bushel. Price on soybeans drops to $6 a bushel. He's got some watermelons over there. He sells those. He has a wipeout on that hurricane. So at the end of the day, he brings in $500,000. He collects $20,000 from MPCI on his corn insurance. So he brought in $500. That's 20. He collects 20 on soybeans. That's 40. $640,000. We guaranteed him $750. He gets a check for us for $110,000. That's in a nutshell how the program works. Okay, what information is required for you? What do you have to get as an agent? You've got to get 5 years of their Schedule F, unless they're a beginning farmer. They made an exclusion starting last year. If you only have 3 years, that's got to be 15, 14, and 13. 15, 14, 13, then you can use those 3 years. Now, if a guy has been, or a lady, whoever it is, has been farming more than that, they have to give those years. But if you've only been farming 15, 14, 13, we can insure you now. And you can do calendar year filers and you can do physical year filers. So it makes any difference. Makes no difference. There's rules and handbook out there to show you how to do the physical and the calendar year. Information about what will produce on a farm during the insured year. You get those 5 years, and then you have to do an intended farm report. What you do there is sit down with the producer and say, what do you plan to plant this year? That's what it is. It's what they plan to plant. It's their intended plant. 100 acres of cotton, 100 acres of wheat, 40 acres of soybeans, 20 acres of pumpkins, 10 acres of watermelons. Okay? Then you arrive at what the production is on that and how much it sells for each unit. So what you're trying to do is come up with what an acre of corn is worth to that farmer. If it's worth $500, that's what you come up and you can prove. He's got 100 acres, 500 times 100, that's $5,000. So on the intended report, you put down he's got $5,000 worth of corn, and you go all the way down. Okay, so you get all that. Now you've got your 5-year average is 100,000, say, and your intended report shows 112,000. Then we insure him the least of those two, unless he's got growth. Now, if you can show that he's growing, he's actually got a way to define that this 12 that he's growing more is 2 more acres of soybeans, 5 more acres of corn. Then you can go up to that 35% growth factor. Okay. This is sort of the way it works on the operation report. You put in an intended report. That has got to be done by sales closing date. So this thing is front loaded, where on your normal MPCI at sales closing, all you got to do is get a signature pretty much. Then you've got to get the production. Then you've got to get the acreage report. With this, you've got to do all that up front. So there's a lot of upfront work. Then at acreage report time, which in most areas is around July 15th, you have to go out and find out exactly how many acres they planted. You do not change the price at that time. We've determined the price by February 28th. That's the part of this policy. If you went and changed the price, it would decline. It would do away with the value of the policy. So we put a value out there on February 28th. Value goes down at acreage reporting date. It makes no difference. We're just getting the actual acres they're planting. And then now, at acreage reporting date, he or she can actually change the crops they're planting if they want. If they, on their intended report, put watermelons, cantaloupes, and squash, but for some reason they couldn't plant squash because they couldn't get seeds, so they planted eggplant. That's A-OK. That's one of the beauties of this policy. It don't make any difference. We're insuring money. Now, if that eggplant, though, the value of that eggplant per acre has got to equal out to at least what his other product did, we may lower the guarantee at that time, you know. But he can change crops. There's no issue with that. And then at the end of the year, you got to do a report before the sales closing date of the next year to finalize what he actually brought in. Sales closing date pretty much rides along with your spring crops in most areas. In some areas, I think it's Texas or somewhere, there's a January 31st date. Most areas of the country, February 28th and March 15th. And that's when you've got to have, it's one of the issues with this, some of the agents have a little bit of apprehension about. There's a lot of upfront work to it because you have to get it done by the sales closing date. As with most of our crop insurance policies, we do not make them pay the premium up front. The premium's billed on August 15th, they have to pay it without interest, by September 15th, and at that point they also have to, they also had to pay by sales closing. If not, they lose their rights to crop insurance. But you also have to go out and do a final operation report, as I showed you back a couple slides ago. You have to do the intended, you have to do the acre report, and the final. If you don't do that final, by the sales closing date of next year, they're limited to 65% coverage. Don't get caught in that trap. You'll have some very unhappy farmers. Okay. How do producers buy whole farm? Just like they buy regular crop insurance. They buy it from you, the crop insurance agent. I would definitely tell any agents out there this is a very new and good opportunity for you to expand your business. Most agents have chased the same business around for years. This is a brand new tool that you can get a jump on a lot of the other agents that maybe are waiting around to see what's going to happen with this product and all this. I believe, and I've got a lot of time invested in crop insurance through the years, I believe this product's going to be around for years to come because it's a very stable product. It's a good product, and a lot of farmers really like it. So I hope that gives you a really good overview of the whole farm policy. It is not an all-inclusive, but you can get with your company. If you're an agent, you can get with your company, and they can help you show you how to fill out the forms. Do not let this thing frighten you. A lot of help you can get from your farmer's accountants. As a consultant with agents, that's what I have in many cases, in all cases almost that I work with agents. I tell the agent, get the farmer to call their accountant and give the accountant the authority to talk with me or talk with the agent, whoever the agent or the consultant. That way I can find out exactly what's going on in that Schedule F. And once you get past that, it's just paperwork at that point. You can pretty much, if you've been doing MPCI, you can do whole farm. Okay, Anna, I think that wraps up my presentation, and I guess we're open to questions.
Great. Yeah, thank you so much, Cliff. Yeah, so I just want to remind attendees that if you have questions for either Scott or Cliff, you can put them in your in the question box in your webinar viewing pane. But I have a couple of questions to start things off. Cliff, you had given an example of where a commodity grower would qualify for a whole farm, where you said they could be growing corn and beans and then like watermelons. And I was wondering if Scott and Cliff, if you could give some other examples of other commodity crops you've seen where growers had most of their crops covered by other crop insurance products, but there was that extra other crop that wasn't covered. Like, what are some examples of those extra crops that folks have had success with whole farm?
All right, I'll give you a real example. Cotton in North Carolina. We have in the cotton policy, if there's any agents on that sells cotton, there is a, I don't want to talk negative, but the quality adjustment in our cotton policy leaves a lot to be desired. I guess that's the word to say about it. It leaves a lot to be desired. You can have a major loss in cotton, right on down to like 49 cents, and still not get a penny from crop insurance if your yields are up a little bit, because you've got to go below 49% for it's quality adjusted. So we've had farmers that are taking this whole farm because this is real money. They've got cotton, a lot of them, they've got some peanuts, and they've also got sweet potatoes, which are not insured. And so there they've got an uninsured crop, two crops that are insured, but this is protecting them if that cotton price drops down because of quality or whatever reason, and their MPCI don't cover it, they're covering the whole farm. That's just one example. I'll let Scott say some, or I'll come up with some more if you want me to. I've worked on a lot of these whole farm policies that have been written, so I've seen almost every crop imaginable fall under it. I can't think of a crop right now that we insure. I've got one whole farm that's covering grapes. They've got sweet corn, grapes, pumpkins, and corn and soybeans. That's their mix. So it's just unlimited, Anna.
I would throw in as well that one of the interesting things about this is the opportunity that Cliff talked about to cover livestock income in this, because some of the livestock policies, livestock's always been a challenge in terms of crop insurance. But we've got a lot of folks around here who are doing direct market beef and grass-fed beef and things like that, and this can pick up. That's something that folks who have rotation often work into their rotation, and has been a way that some folks have gotten off of, have gotten into higher value markets around here, and so this is a way to pick up a significant amount of that income as well. So it's pretty much anything that winds up on your Schedule F.
Awesome. So that could include, so for our Midwest systems, that could include organic oats, or maybe some especially seed crops, or I met a producer once that produces thistle seed for medicinal purposes. So kind of anything that, but cover crops would not be covered under whole farm because they don't produce revenue. That's right? Correct?
Yeah, and so one of the things that is a change in crop insurance over the last couple of years is the addition of the organic price selection in a lot of the regular multi-peril crop insurance policies. So many of the regular multi-peril policies now have an organic price selection, and USDA is committed to sort of finishing that out and continuing to add those. So in terms of organic, there are they should definitely look at that opportunity as well. So there may be a way to cover that just within the regular crop insurance. But yeah, all of those other things, I think I said earlier that, I worked with some growers and worked on soybeans that were going into a tofu and natto market and for Japan that were higher value and had a clear hilum and, a series of other things on them that were for those specialty markets, and we're selling at, double or so of the regular commodity price, so that would be able to be covered, would be captured here.
Great. Okay. So you covered already kind of how much time it takes to get one of these policies in place, but I guess are there any common hiccups or surprises that you've seen crop insurance agents run into when they are writing one of these policies for producers?
Yeah. Coming up with prices is always the very most difficult part. The Schedule F, people thought that was going to be a problem. I've not seen any reluctance from any farmers I've worked with as a consultant, not the first reluctance on Schedule F sub. You may in some cases run up with people, some of you smaller farmers that don't report their income sometimes for IRS, but those days are gradually going behind us. Most farmers now, they have to track their records for tax, and not so much for tax records, but for getting loans. They want to show their income, and then they got their depreciation, and all that stuff. So that's not an issue. The biggest issue I see across the board, the biggest issue is coming up with the production and prices of whatever commodities is actually worth to that farmer, and Scott has hit this several times. He's hit it real hard, and it's really, really important. This product will cover those outside the box things. If you're growing organic corn, so you're growing organic corn for a grower down the road, it's a commodity. You're growing field corn. You got 100 acres of organic corn you're growing, and you're growing it for your neighbor down the road that sells to Whole Foods, sells organic chickens to Whole Foods. He's selling those for double, so he's paying you double for your corn. So instead of getting $3.50, you get $7 a bushel wheat corn. Now, a farmer needs to keep up with those records, and that is the biggest obstacle, because that farmer's got to have the records. If not, me as a consultant or an agent, I've got to figure that $3.50 what RMA's calculation. So he's going to have a 5-year average of $100,000, but his intended report's not going to show but $75,000 because he's not compensating, because the agent's having to use that. That is the very toughest part of selling whole farm. Just as with MPCI, there is no difference in this and MPCI. The hardest thing is records.
Great.
And Cliff, I would add to that if a person can document a contract on a price, if they've got a contract for a price, that can work as well. So you need both the records over time, but if they've got something that is in writing that is a contract for a certain price, that can be used.
Yes, exactly. And I'll give you a perfect example. There's a grower down in Arkansas that grows a lot of edamame, probably about 400 acres of it, and it's organic. It's organic edamame, and I don't know exactly who he sells to, but he's got it under contract, and he's getting a really good price for it. So that contract has got to be accepted by the company. Can't be something that somebody made up. It's got to be a verifiable contract, and his was, and so it was accepted by the company. So you're exactly right, Scott. And agents, there is guidelines in the whole farm handbook to tell you what is considered a valid contract and all that. So there's a lot of guidance out there for agents to use.
Great. We've got a question from one of the participants, and they're asking, if a farmer has irrigated and non-irrigated practices, are those considered different commodities? For example, irrigated and non-irrigated soybeans or irrigated and non-irrigated corn. Would that be 4 commodities or 2?
Two commodities. You might put 2 different, you make it come up with 2 different yields to come up with the prices, but it's 1 commodity.
Okay, thank you. Yeah, I just want to encourage participants to, any questions you have about whole farm, we've got, Scott and Cliff obviously have a whole lot of expertise between the 2 of them, so, send us your questions over. I've
Anna?
got another one. Yeah, go ahead, Scott.
Anna, I was just going to throw in that one of the places that I've seen people trip up is that if regular multi-peril is nested in a whole farm revenue policy, or if a person receives disaster programs, disaster payments or ARC or PLC payments or other things like that, those payments become part of the gross revenue, and so they count against the income level. But when it comes time, the next time to figure out the average income, those government payments are not part of that record. And so if one year half of your income came from a combination of crop insurance and other disaster payments, unfortunately, instead of being able to count that entire income in your 5-year average, it would go in as half of your income, the part that actually came from the farm. And so sometimes, that's something that can catch people over time, and that becomes that can be a knock on that 5-year average.
Yeah, this product is not going to work for somebody that has a loss every year. Bottom line, it's not. If you're planning on buying this product and having a loss every year, like some of our people do on MPCI, and we've done a lot of things on MPCI to block up those people and chalk them up. We've got yield exclusions, yield adjustments, and all kinds of things. There is none of that in this whole farm. Now, it may be in the future, but at this point, if you have loss after loss, it's going to catch up with you, like Scott said, really fast. If you have one substantial loss in 5 years, yeah, it's going to dip you a little bit, might not kill you, but you start having 2, 3 out of every 5 years major losses, it's going to hurt you, because remember that crop insurance, like Scott said, is not going to count as revenue. It's going to count as revenue for that year of the claim, but it's not going to count as revenue the next year for your actual establishment of your revenue for guarantee. And there's been a lot of arguments on that. A lot of discussion. I ain't going to use the word argument. Been a lot of discussion on that.
Great. Thanks, both of you. We have another question from a participant who's wondering about the commodity count. So if you grow 500 acres of corn and 500 acres of soybeans and 3 acres of pumpkins, does that truly count as 3 commodities and qualify for an 85% level of coverage?
All right, let me tell you what you do there. Whoever's doing this, sit down with a pencil paper and a pencil, and let me tell you how to do this. Take those 3 commodities and come up with the value of them and divide that, whatever the value of each one. If that 500 acres is worth 100,000 or 10,000, the other 500 is worth 10,000, and the 3 acres is worth 3,000. That is $23,000. Divide that by 3. What is that? That'll be 6, 7, that'll be 7,500, let's say. multiply that 7,500 times 0.33, and what is that? That's about 2,200. So that, though in that scenario I'm talking about, that would have to be at least worth $2,100. Now let me tell you what I'm saying, how they come up with that. In utopia, in a perfect world, a guy's crops or a person's crop that's farming would all be worth the same value. But that don't happen. We don't farm in utopia. We farm in North Carolina and Nebraska. Okay. So you take the number of crops, you multiply it times that number into that total value of all the crops. Everybody follow me? Total value of this guy's was 23,000. Divide it by the number of crops. You get the number, and then you find out what that value is. Then we say it's got to be worth at least a third of that. Follow me?
I think so.
Okay. Now, if you don't want to do all that, I tell you what you can do. You can go to RMA's calculator and punch in the numbers, and it'll tell you how many you qualify for. You don't have to go through all that. I just like it. I actually help write a lot of this policy, and I come up with some of these things. So that's how I know some of this. Some people call it useless information, but that is the way it's established. But if you want to know positively, go into RMA's website, go into the cost calculator, and go to the whole farm section and put in the 5-year average, and then for the intended operations report, put in the crop, the dollar amount, and it'll tell you exactly. That's the best way to do it, Anna.
Okay.
But now, as agents, let me address this. As an agent and a consultant, I like to make sure farmers get the maximum bang for their buck out of anything. So as an agent or something, what you can do to help your policyholders or somebody you're trying to sell to, if they're sitting there with those 3 commodities and those pumpkins, those 3 acres they've got is right on the edge of being a commodity, you can tell them, you can run the numbers and say, hey, if you plant 3.5 acres, it will be included as commodity. That's where it's important for an agent to understand this strategy I'm talking about. Because if he's got to plant 3 times as much, we don't want to change what the guy's planting, but you need to give them their options. So I look at it and I say, hey, look, you've got 200 acres of soybeans, 150 acres of corn, 50 acres of wheat. Now, I'm not telling you what to plant, and I'm not getting into your operation at all. I'm telling you that if you go to 55 acres of wheat, it will be considered another commodity. It will give you a more diversification. And if you've got one crop, it could give you that second crop to help you get that 80% subsidy. Okay, keep in mind also, agents, you can lump small crops. If this guy that you're talking about had 3 acres of pumpkins, 1 acre of strawberries, and 2 acres of sweet corn, you can lump all those together to make one crop. Okay?
Okay. That's really helpful. Thank you, Cliff. I have another question from a different participant who's asking what size of farms benefit the most and what size of farms benefit the least from whole farm.
Who benefits the most? The guy that has a loss, has a severe loss. He's the one that benefits. But that ain't what he was asking. What he was wanting to know is what commodities I think would benefit the most. Well, you know, the commodities that don't have insurance are going to benefit the most because these crops don't have insurance at all. But that is really a question that I don't know how to answer. Diversified farmers get lower premium rates, more subsidy, but there's less chance of them having a major loss because they're diversified. That's part of the reasons for diversity, is to spread your risk over 5 crops. Okay. So a 1 crop producer may pay more premium, but is a lot more chance of him having a loss. So when people ask me, who is this policy good for? I think I said this right up front. I'm a firm believer, and I've worked with crop insurance now for 40 years, probably altogether. This is a good product for anybody. I'm not saying everybody buy it. I'm saying it's an excellent product to show everybody. Some farmers are going to laugh at you and say, there ain't no way I'll never get a claim on that. The next farmer is going to say, wait a minute. You're going to guarantee me $750,000 no matter what happens, the price or whatever? I like that as an umbrella over my policy. So, I don't know, Scott, you may address, when you say who it's the best for, I think it works for, it really works best for somebody with 2 or more crops because of the price break. But a person with one crop, it's good coverage for them. Might be a little more expensive, but it's good coverage.
And you know, I'd add to that, Cliff. You know, if somebody has only commodity crops into a wholesale market and they feel like their crop insurance is really covering all of their income, they've got revenue policies, and it's really, you know, that looking at their total, you know, their total indemnity versus what that average, that 5-year average is on their Schedule F. You know, if they're already covering all of it, you know, good, that's great. But if that number is off, you know, the more that number, their total coverage versus what that 5-year average of the Schedule F is, the further apart those numbers are, the more that the better this will work, or the more important it is for them to go after this. You know, anybody. Part of our experience is that a lot of times we've got folks who are trying to bring a son or daughter back onto the farm, and to do that, they've got to take the same amount of farm and they've got to make more money on it. So they're looking at higher value crops. They're looking at going into other markets. And the person who's going to really determine whether they can do that or not really is their banker. Often it comes down to, will my banker allow me to do this? Will they lend me money on this or not? And so in a situation like that where you're trying to go after a higher value, this can be a real important piece of that puzzle, because it allows, you know, it allows the banker to lend on something, or it gives the banker a comfort level in lending that they might not otherwise have with something that's a little odd, or something they haven't seen before, or something they don't see every day. So, you know, you know, the easiest, and you know, see what you think, Cliff, but I think one of the easiest things is, what's the difference between their 5-year average on the Schedule F and their total crop insurance coverage? If that, you know, if those numbers are really close together or are the same, you know, they're doing pretty well. But if they're not, they need to look at filling in those gaps.
Yep, that's a good way to look at it. I've looked at it from all different angles with farmers, and every farmer has, just when you go in to buy stocks or you go in with your 401k, and we've got agents on here and we've got financial people, so they understand those. You do a risk strategy. Every farmer has a different tolerance for risk. I play games with FFA students. I've got a game on iPads that I play with them on crop insurance games, and it could be used on car insurance, health, anything. And some kids are like, I'm going to buy the lowest level of insurance, or I'm not going to buy it at all, I'm going to take my chances. The next kid, he's sitting over there, a 15, 16-year-old kid, they'll say, you mean tell me for $10,000 you're going to give me $200,000 in insurance? That means I never can lose my money? They'll buy it. So you talk about what's the best, but I do agree with you, Scott, on the point that, if you've already got all your crops covered and you like what you got, there's nowhere near the benefit of going out and buying whole farm on top of that. If you're buying revenue on every crop out there at 75% level, I'm not sure I would tell a farmer, hey, you need a whole farm also. I've actually told some farmers they were very satisfied with where they were at on their corn, wheat, soybeans. And I've come right out, run the numbers on them, and I told them, I said, you know, in your situation, I'd probably stay where I'm at. And there's nothing wrong with that. That's what we got all these different products for, you know.
Great. Any final thoughts? Any final questions? We're about on the hour, so okay, well then let's wrap it up. Thank you so much, Cliff and Scott, for sharing all your thoughts and wisdom on this program, Whole Farm Revenue Protection. And thank you everybody for joining and participating and for your questions. And we will be sending out an email to the folks who signed up for the webinar, updating you on sending you the link to the recording if you'd like to share it with others. And otherwise, we'll call it good there. Thank you again.
Thank you very much. Have a good one. Bye.
Thank you.
Take care. Thanks. Bye, everybody.
Bye.